Last week, the jobs report came out and it wasn't good. So what you would expect is that mortgage rates would go down, but actually they went up. They did the opposite of what experts were predicting. So why is that? So in this video, we're going to dive into the number of reasons why mortgage rates went up, especially when the jobs report was so disappointing. Okay, let's start with the big headlines. The headlines were that 12,000 jobs were created in October. So that is way under what the experts were predicting. In September, there were 223 jobs that were added, and they predicted in October it would be 112,000. And what actually happened was they were 100,000 jobs off. So only 12,000 jobs were created. When there are low jobs that are created, then you would think that mortgage rates also would follow. They would go down, but actually they went up last week. So now they're hovering around the 7%, close to the high sixes. So why is this? So there are a number of reasons. Hey, real quick, if you're new to my channel, welcome. I'm Jade, and I'm a full-time realtor here in San Diego County. And I also make videos on the housing market so you can stay informed, especially when you are thinking about making a move, buying a property or selling a property. So if you have any questions about your specific neighborhood or your specific property, don't hesitate to reach out. My number is right here on the screen. So call, text, email me. I would love to hear from you. Okay, let's get back to the video. So first, looking at the jobs report, what the actual numbers are. Okay, looking at the graph from CNN, you can see here, U.S. economy added 12,000 jobs in October. Unemployment rate remains at 4.1%. So as you can see, in October, there was only 12,000 jobs that were added, and in September, it was 223,000. So that is a huge drop off, a major just cliff that happened here. And at the height of the year so far, that was in March, when 310,000 jobs were added. So as you can see from this graph, there is a huge drop off here for October, a lot less than was expected. So despite the low job growth, one of the factors that are also affecting mortgage rates is the unemployment rate. And the unemployment rate held steady at 4.1%. So this might not seem like a really significant number, but actually investors really look at this number and they bet against it on whether that the Federal Reserve is going to cut their rate. So because the unemployment rate held steady, this is a good sign that the economy is holding steady and still solid. So another factor that is affecting mortgage rates is wage growth. And actually last month, wages went up by 4%. So this is another signal that the economy is doing well. And if people are making more money, then there's a chance that they'll actually spend more money. And if they spend more money, then that also increases the chance of inflation going up. And if inflation goes up, then investors don't like that. That makes them a little bit nervous. And so to combat that, mortgage rates go up. So coming from the Economic Policy Institute, you can see the nominal wage tracker, key numbers on the nominal wage. So right now, actual year-over-year growth for private employees is 4.1%. And then as you can see on this graph here, during the COVID years, obviously it was very volatile. And in the last few months, it's been holding steady at 4.0%. So for September and August, so here, just as August was 4.0%, and in July it was 3.9%. So wage growth has been holding very steady. So even though that job growth was slow, there was steady unemployment and wages actually went up. So this signals that the economy isn't doing badly, but it's actually pretty solid. So investors see that and they worry that inflation might go up and that might mean that the Fed's raise their rates. And if the Fed raises their rates, that indirectly affects mortgage rates, and which means, my friend, that mortgage rates might go up. Another key point is that the jobless claims are still low, which means that layoffs aren't happening and companies aren't downsizing, which means that the economy is still strong, it's resilient, and this is why mortgage rates didn't dip after the jobs report. So let's take a quick peek at the current mortgage rates right now. So according to Mortgage News Daily here, and the 30-year fixed rate mortgage right now, according to Mortgage News Daily, is 7.05%. So as you can see, there was a dip in September in anticipation of the federal funds rate being decreased. And so that happened. Mortgage rates went down. But then since then, they have been slowly creeping back up. And right now we're at 7.5%. 7.05%. Looking at data closer to home and what's happening in San Diego County. So if we look at Redfin's weekly housing market data, we can see the new listings that have come up. So as of last week, there were 546 new listings, and this is 5.8% higher than last year. And what's really interesting, if we look at the median sales price, there has been a sharp increase in the median sales price. So right now it is at $915,000 in the county, and it is a 6% increase compared to last year. And if we just quickly look at days on market, then you can see, kind of get a sense of how much buyer demand there is. And it has gone up. So right now, as of last week, it is taking 28 days to go under contract. So that's kind of holding steady. So it has increased 12 extra days compared to last year. So sellers can expect for houses to sit longer on the market, and on average in the county, it's taking 28 days to go under contract. So let's talk about what this all means for the housing market and going into 2025. So for buyers, it would mean that if mortgage rates stay elevated, it's going to be difficult for a lot of buyers to jump into the housing market and also make their monthly payments. And then combined with higher housing prices, this could keep a lot of first-time home buyers on the sidelines. But here's a twist. We still have a big problem when it comes to housing inventory. Inventory is still at historic lows, which means that even if buyer demand dips because of the low inventory, then housing prices are probably going to still hold steady, even with that dip in buyer demand. So we'll probably see more of a balancing act and prices leveling off instead of dropping. And that's a big difference from the outcome that a lot of people are predicting, that there is going to be a price correction. And heading into 2025, the economists predict a few different scenarios. If the economy stays strong and the feds keep rates up to control inflation, then there might be a cooling in the housing market. So prices might inch up just a little bit at a snail's pace, or they might just hold flat in some areas. But don't expect a market crash. There just is too much demand and too little supply to expect a housing market crash. So there you have it. Thank you so much for staying all the way to the end and digesting all this information with me. If you have any questions, please don't hesitate to call, text, or email me if you have any questions about your specific neighborhood or property. And also, if you found any value in this video, please hit the like button, subscribe. And if you found this video interesting and helpful, please check out this one as well.